I don't think it's unique that we saw the wildest run I can ever seen in my 15-year career, post commission free, post Robinhood, post all these crazy loons on Wall Street bets in Reddit. I don't think that's a coincidence. So then on the flip side, if you're short biased, just, I know it's so hard. I know it's so hard to wait, but if you are, this will fade. I mean, this will fade. Every one of these stocks will fail. If you can be patient, go to the beach, read a book, there's opportunity on both sides. And that's what's great about these. Welcome back to the Steady Trade Podcast, everyone. I am Tim Bohen here again with Kim and Steven. We've got the whole crew here today, and we've got a topic that probably many of you are familiar with. I mean, you pretty much have to be living under a rock if you haven't heard about it. But obviously, the coronavirus has been a huge thing in the media, starting back in January. All of this panic. I actually have. I'm almost embarrassed to admit that I have friends that actually stockpiled toilet paper, but I don't know what you're going to do with toilet paper in the apocalypse. But nevertheless, I'm sure you've seen it. You've seen the news. You've seen all this stuff, the hand sanitizer stuff. The wild thing is, what's great about these situations is they create the biggest opportunities, and it's particularly in penny stocks and on the long and the short side. I think back to the Ebola stock run, which was 2014, maybe. Don't quote me on that. You can Google it. But, same scenario. There was a breakout of Ebola in the African continent. Stocks went wild. Actually, some of the same stocks went wild here 6 years later. But, this coronavirus is, in my opinion, much more real and more widespread than Ebola. And that's why I think we've seen this 6-month stock run. So we're going to talk about hot sectors, why you target these, things to do as well as don't do. So welcome, Kim and Steven. I hope you've sanitized your hands before the beginning of this podcast. So.
I just want to quickly jump in, and because it's a really important time right now. Now we had a Twitter conversation, which many people would have saw, Tim. But I want to preface this conversation with one very important thing. The stock market is kind of quote unquote crash, and it's certainly declining more than it has since maybe 2008. But I want to preface it with stock traders who know what they're doing and have a plan will make money on the long side. They'll make money on the short side. Even when the market's going down, even longs will still make money. The only people that will not make money are the people who they trade casually. They don't have real plans. They don't really know what they're doing. But those who are invested in the market every day and know what they're doing will make money no matter what the market does. I mean, just to kick it off, you make money both ways.
That's the beauty of, something that we talk about, something I've preached. You can go to my personal YouTube from 10 years ago, and there's videos where one of the most important things is to show up every day. I mean, back when I had my business, I couldn't trade every day, but I still ran the scans. I still read the news. I still saw what was going on. And if you just try and dip your toe in and out where you're like, oh, I got a day off from work, I'm going to trade, man, thank you. That's the dumb money, man.
Yeah, but also the casual investors, those people who've got like, oh, I've got 20, 30,000 savings, let us put it in the market. These are the people that will lose the money, but the actual day traders who read the trends, know the patterns, know how to play them, they will win money long or short, but the casual investor is the one who loses, and the day trader is the one who wins generally. And the classic example of how to make the money is because people who are maybe more biased on people who are trading the higher price stocks, they'll be shorting for fun. And the people who are trading the lower price stocks will be going long the coronavirus. So there's something for everyone, right?
All right. I have a question, guys. So I was kind of curious, what what forced the crash the other day. And while I get that it could be coronavirus and that's part of it, my first take when I, kind of looked quickly at the news was that OPEC had blown up. So I was thinking maybe it was more OPEC than coronavirus, but that just didn't help and pushed over the edge. So what's your take? Both of you.
I'll go first. Yeah, my opinion is it was both. So
it's both.
Number one, listen, you can look at a chart of the overall market's last 10 years. We've been straight up with no pullbacks. So when you've done that, when you're straight up with no pullbacks, people are timid, especially like big hedge funds. I mean, if you're sitting on a billions of dollars and all of a sudden there's a pandemic and the oil price of oil crashes, you're just taking profits. I mean, it's not that they are necessarily shorting the market or any of that. They're just like, holy crap, let's go to cash. We're up 40, 50, 100% or whatever. But in my opinion, the biggest thing is, again, the concerns about the supply chain. The simple fact is, as much as I hate this, so much stuff is manufactured in China. So much stuff is manufactured overseas. And if you start getting ports shut down and you start getting airports shut down, it doesn't matter how amazing the iPhone 12 is if you can't get one, if you can't sell one. And in my opinion, that is the biggest reason the market's sold on edge. And Stephen, you can answer your opinion.
Okay.
No, but I mean, just from my neck of the world as well. I mean, I know that obviously there's a lot of fears about coronavirus, which sank the market. But it's also the news of the oil prices, because I know that based on the fundamentals, I know that there's been some problems with too much oil, and I know that Russia was saying, or Saudi was saying to Russia, we need to control this. And Russia said, I'm not lowering the price. So Saudi said, well, fine, I'm going to produce as much as I can. And then based on that conflict and that news, the market just crashed further.
Not to get too in depth in the market, or in the fundamentals, because think about it. Saudis, I mean, they are heavily, heavily, heavily invested in the U.S. stock market. Heavily, okay? Yeah. So if you think about the fact that, okay, they're getting in a price war with Russia over oil, okay, price war, fine, but they still need cash. So that's the other macro idea would be, are they going to start selling stocks because now they're in a price war with Russia over oil? So that's
So can I throw this past you and you give me your opinion on this? So a colleague of mine that I was talking to yesterday, he thinks that war between the Saudis and Russia is kind of made up, and it's forcing the U.S.'s hand because we have been so involved in fracking, and that it's not turning out to be what everybody thought it was going to be. So this concept of, which now they're not even calling it fracking, they're calling it, what do they call it? Shale, right? Sounds so much more sexier and not as, like I remember New York City, there, Hell's Kitchen, the real estate market wanted to start calling it Clinton instead of Hell's Kitchen to help it sell better. So I was just curious, like, is that a perspective that maybe we're just overextended in that particular market with our own, oil production? And
well, I mean, remember, America shifted to we're the biggest producer of oil now, so that is definitely, again, and I don't know if I believe or agree with that theory, but the simple fact is, again, if the number 2 and 3 biggest producers get into a price war, that's going to affect the American economy, because now the last few years we're cranking out oil and especially natural gas like crazy. And price wars, what's that mean? You shut down wells, because if you're pumping oil, and you're not getting any money for it, they shut off the wells, they lay off people, that affects the economy. So
how deep do you guys go into these topics, whether it's the OPEC, whether it's coronavirus? Like, I think I'm trying to just learn. Like yesterday's conversation with him, part of me was like, should I be taking notes for me to potentially use when I'm, so I'm just curious, like, because I'm still learning so much, how deep would you say you want to go into this, or spend time looking at the papers in the morning or the different headlines?
Stephen, you go, because I want you to, because I'm gonna have a different answer than Stephen, but I want Stephen to answer.
I think you're gonna have the same answer, to be honest. I think I think the answer is you don't need to actively research the news. You need to look at the stock market and see what's happened, and then just kind of understand why it's happened. But the important thing is to see that it has happened, and then learn why, and then react. You don't have to actively spot something before it happens and then guess what the stock's going to do. You need to see what the stock's done and then react based on that.
Okay.
So actually, there was a reason I wanted Stephen to go first, because he's right. We agree. Now, I will say this, and I'm talking penny stocks, which is what most of our listeners are trading, and I think is the best thing to trade. Okay, you're competing against idiots in penny stocks. That's what we want. Okay, so me personally, I'm a stock market dork. So to answer your question, Kim, I read it all. That's all I read. All I read. Wall Street Journal, Barron's, Investors Business Daily, Bloomberg, every single day. But I will say this, when it comes to trading, momentum, low float stocks, none of that reading helps me in any way, shape, or form. Okay. Yeah. So Stephen and I are actually agreeing here. Yeah. Even though it's all I read, well, other than books, it doesn't help you in penny stocks at all. If you're paying $50 a month for a Wall Street Journal subscription, it ain't helping you in penny stocks.
And can I also just add to that and say it probably harms you more than it helps you, because the more you read the news, the more you get biased, and the more you let the news counteract the price action, where price action is king.
Okay.
And that's my point, Kim, is that's an advantage of penny stocks, is you don't have to do that. I mean, listen, if you're some junior analyst at a hedge fund, you have to do all that because your boss is looking for some macroeconomic whatever play. If you're trading your own money in penny stocks, I mean, you can open up StocksToTrade or any scanning platform, and all you see is, this last few weeks, 10 of the biggest gainers are all virus plays. With one click, you're like, well, I know what's in play. You didn't have to read anything.
Okay. All right, so Stephen, you had an experience with coronavirus the other day. Will you share that with us?
Yeah, but just to add one more thing, like this is like penny stocks is so simple that it's amazing that penny stocks is more penny. The thing with trading higher price stocks with a lot of like hedge funds is it's like who can do the best research. But with trading penny stocks, it's more who can manage their emotions the best. Because it's a good, I know it's the higher price stocks, you need more intelligence, but it's less volatility. So you need to manage your emotions less. But penny stocks, you need to manage your emotions better, and you need to simplify the process of analyzing them more. Because with these coronavirus plays, it is literally 4 variables. It's like high volume, low float, corona sector, buy the breakout. That is
day one press
it's
release.
mental.
Day one press release.
Day one press release. But that is it. If you can tick those 5 boxes, you don't need to know trading more than a week. It's just managing your emotions. It really is. And going back to the conversation I had with Tim, I saw the market crashing. I was in the middle of work. I just withdrew the profits on my account. I had a $500 account. I saw a stock up, and I just thought, F it. But F it, I'm going long.
Give a little bit of context. So number one, and this is one thing we talked about earlier that you left out. Your bread and butter play is shorting crappy biotechs. That are not hot. So
which is why I'm not trading right now, by the way, because every biotech is hot. So I'm not even trading right now.
So basically, what had happened, you hadn't had for however long one of your plays.
Couple of weeks.
You come in Monday morning. Okay, go, and I'll let you go. But
yeah. No. So basically, I mean, my strategy is to short failing biotechs. And to be honest, my strategy is if the lowish volume, high-ish float, or even moderately float, or even lowish float, very low volume, not too low, because if it's too low volume, it can be manipulated and it can skyrocket. But if it's like moderate volume, 300 to 500,000 pre-market, and the float's 20 million, you can pretty much short them all day, and 90% of them are going to fail. It's 90% proof strategy. And if it's like a 5 million float and you've got like a million volume, you can still short those, but you've got to let them run a little bit in the morning, and they'll generally fail by 10, 30, 11. They'll put up a fight, but they won't put up too much of a fight. But over the last 2 or 3 weeks, my strategy has turned upside down. because with coronavirus, every company trying to find the cure is a biotech. And
Yeah,
my
I started out
strategy
like,
is short biotechs.
so I had a spreadsheet of coronavirus plays. Like a month ago, there was like 9 stocks on there. Last I checked, there's like 38 stocks on there. You know,
Due diligence, though. Good for you for doing the research.
Well, but none of them, remember, none of them, and this is for the listener, Steven knows this, you know, as I say this list of stocks, none of them will accomplish a single freaking thing.
Nah.
But they know the game, and they you know, Steven Johnson Biotech, we're going to cure coronavirus, and they get the press release out, you know.
Yeah, but I mean, I'm not the only wizard in the world who's figured out the strategy that biotechs need to raise money by pumping up the press release, and most of the time they fail. I'm not the only person who's figured that out. And I'm also not the only person who doesn't have very good discipline. So I'm not the only one. So like for me, I had a cracking start of the year, January, February, like $700 and 8,000. But the minute I lost 2,000, a great run. But then I lost 2,000 in March, which is fine because you should have these red months. But the difference in trading is like as soon as I saw the market turn, and I know this because I've lost before. As soon as I saw the market turn, as soon as I saw the pattern not working, take your profits, start with a $500, $600 account, limit your losses until the market turns back around. But a lot of people will not. A lot of people will short hire.
Oh, I saw people, you know,
accounts.
like a week or so ago when you withdrew that money, I saw people giving you a hard time. And I'm like, you know, I don't reply to anyone on Twitter. I post crap all day long. I will not reply. But I'm just like, he's smart. He knows he has discipline issues. He knows he falls into these traps. He's pulling the money out so that when and if he makes a mistake, he minimizes his loss. I'm like, he's smart, you know.
Oh, dude, like if I take 10, like say I made $5,000 so far from the market this year. If I take 10 grand, that's a brilliant year. Like I made 10 grand this year. So then next year I'll try and make 20, and the next year I'll try and make 20. The next year I'll try and make 40. But it's a step-by-step, gradual process. Disciplines formed over time. Mm-hmm. I mean, I must have blocked these people because I didn't say them. Like I've obviously blocked them. Because I block all the haters, the same as Sykes.
That are saying this to Stephen, that are saying to give him a hard time for taking his money out. But are those people that they're just not mature emotionally yet around what
their idea is, and hopefully none of them are listening, but their idea is, you know, and this is the trap that so many fall into. Their point is, well, Stephen, you turned it, you know, you made 10 grand trading $1,000 at a time. Trade $10,000 at a time and make $1 million, bro. You know, that's the bros that drive me freaking nuts. And that's their point. They're like, well, if you turn 700 into 8 with 700, you should be trading with 7 grand. And Stephen knows he has discipline issues. He knows he doesn't need to size up. So that's their point, you know.
Yeah.
But and the other point is 95% of traders lose, which basically means nearly everyone who gives you advice on Twitter, you should do the opposite of.
Nearly.
It's just the truth. Nearly everyone who gives you advice, you should do the opposite of.
It's almost like they're vicariously wanting you to do it because they don't want to risk their own money. It's like, have it, you do it, dude, and don't tell me what to do.
But I love your point, Stephen. I love your point. I'm actually going to steal that quote, you know.
But no, like when I was running the live streams in January, and everyone would tell us to do one thing, and I'd be like, everyone is wrong 95% of the time. And I think I'm right. So it's about having the courage and conviction to think, nah, like I know what I'm doing. You guys don't. But not too much about me, but to go back to Corona.
Well, actually, and I want to talk about AIM because I want to talk, we kind of got away from it. Break that down. You know, we can talk about yours and my Twitter beef if you want to joke about it. But I think there's a lot of lessons in there, both what you did wrong and what you did right with AIM. So finish that story.
No, I can break down the analysis of AIM really, really, really easily. The history of AIM is that the company has no money. It's not got any long-term plan of ever making any money unless it solves coronavirus, which it's highly, 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 highly unlikely it won't. So they're two very, very bearish factors. The technical analysis on the 2-year, 3-year chart is that every time it gaps up, it fails. The fundamentals in the SEC filings are every time it does gap up, it will have it'll release a 42415B or whatever it is to raise money to keep on existing. So they're 4 very bearish signals, and then there's like 4 bullish signals, but the bullish signals have much more precedence now because they're much more stronger than they would normally be, and that's coronavirus is extraordinarily hot, which it was a corona play. The volume was extraordinarily high. It was like 100+ million on the day. Float was on only 20 million, which is very low in relation to the volume, which is rotating more than 5 times. And the stock, to be honest, it had gapped to its highs in the last 3 to 6 months anyway, which means all the shorts are squeezed, which means it's like 5 bullish, 5 bearish. And the overall market was downtrending, but that's kind of bullish in a weird way because Corona's going up while the market goes down. So it's kind of like there's 6 bullish and 5 bearish signals, which means it's a 50-50, which would normally mean I would take it, but I'd let it run before I shorted it because it's mixed, or I wouldn't take it because it's a coin flip, and there's conflict in indicators. But because Corona is so hot, because the volume's so high, that's like 80% of what your weight should be, and all of the other indicators are like 20%.
Can I just ask what conflict meant?
The conflict is like, say there's 6 bearish and 5 bullish. It means that if there's, like, say it's a tug of war and all the bulls are on one side and all the bears are on the other, it's a conflict because you can't pull either way. And unless you've got all signals bearish or bullish, you don't.
I like to think maybe I kind of helped contribute to Stephen on this, like something I'll do, Kim, like in webinars when I'm coaching this stuff, I'll kind of I'll tick off the negatives and the positives, and something just like Stephen said, if there's 5 negatives and there's 5 positives, that's not a trade. You're just, it's a coin flip at that point. So what he's saying is there probably was no trade because everything's conflicting. You want like 5 positives and 1 negative or 2 negatives. Yeah. Then that you're checking the boxes.
Got it. Yep. Are those the variables that Tim Sykes talks about? They are. So you're looking
and what we've talked about.
Yeah. Okay. Got it.
But if there's 10 indicators and all 10 indicators are bearish, that's when Tim Grattani says the stars align and he goes full size bearish. If 10 signs are bullish, the stars align and you put a lot of your money on bullish. But most of the time you're not trading your full size because there's too much risk, or there's a little bit of risk and you don't want to go through with it.
Okay. Makes sense.
So talk us through the rest of AIM then. So number 1, you were itching for a trade. And you even said that things were conflicting, but you still took it anyway.
No, I mean, basically what happened is because my bread and butter strategy is to short biotechs, and now my strategy is reversed on its head because biotechs are running, because the companies that will come up with a coronavirus cure, or will at least pretend to, are biotechs because it's in that field and niche. So that industry's gone hot to the long side, where typically it's very hot to the short side. And I just got frustrated. I didn't take a play. Or I didn't take a winning play for a while. I only had $500 in my account because I withdrew the profits. And I just thought, stuff it, I'm frustrated. The market's going down. What will be, will be. And if I lose the money, good, I won't trade for a week. That's basically what happened. It was in the heat of the moment decision. And then 2 days later, I was like, what was I thinking? Why did I do that? But that's it. That's the truth. I didn't even look at the news.
What do you do, though, if Stephen, you have this particular play, you're not going to see that maybe for a while in the market. So then what's the recommendation for somebody whose normal play is not going to be available for a while? Do they want to learn a new one?
That's a good question. And Tim Bohen says, go read a book. I would say go to the beach and get a tan. Look, it depends. And it's so fascinating. We had the guy on the other day, right? He says he trades every 2 weeks. Says he waits for his play and he doesn't take any. His play works 90% of the time.
Dell the trader.
Dell says he every 2 weeks when his play comes, he puts good amount of money on it. He's got a 9-to-1 risk reward. He makes a lot of money, and all of the other trades he might give some, win some, give some back, win some, give some back. Like, there's no point. So as a new trader, you should always watch the market until your eyes bleed. I agree, but after 2 or 3 years, once you've established what works based on your personality, then it's a case of going out and walking away and not trading.
Yeah, that's Kim, he's totally right. I say it all the time. It's like, one of the reasons I go, we talk on the podcast all the time of, just use trading as a side hustle. You don't have to sit here every day. And I think that is one of the biggest mistakes people make is they're like, okay, I'm here. I just spent 2 hours running scans, looking at charts. I have to trade something. No, you don't. No, you don't. And if your setups, like Steven says, I mean, his percentage when he focuses on his wheelhouse is through the roof. So the best thing Steven can do is go to the beach.
I'm going to play devil's advocate here especially because of the concept of the emotions, right? Like just these conversations and what I'm moving towards is making me feel excited about being part of this, right? This particular, like everybody and their mother's talking about the market now, right? So here I am, a new trader. Let's say I have my particular pattern, like Steven's pattern. And then you're basically telling me during the most wildest ride of all, I'm not supposed to be in there. That is like, it's like being like the prom. You get to go to every dance but the prom, right?
Well, but that's because, remember, keep in mind, Steven is a short bias trader. And there's a lot of people that are doing really well on the long side, okay? So if you're a long bias trader, you would be trading every day, okay? But it's just, recognize, like I mentioned earlier, this is the hottest sector maybe ever that I can remember. I think at this point it eclipses weed, it eclipses Bitcoin, it eclipses Ebola. So the point is, Kim, you're right, but if you're a short bias trader, this is not a time to be aggressive, So now I'll tell you this. Remember, shitty penny stocks. A month from now will be the time to be a short bias trader on these things, because you're
never going to wait that long. You have to, if you stay out of the pool for a period of time, it's not going to be more than a week or two or a month.
Yep.
Yeah, that's it.
Okay.
But if you're addicted to trading, just withdraw your money and trade with a small account and lose as little as you can.
Okay.
And then when the patterns come back around, you'll naturally have the crazy percentage exponential growth, and you'll build your account quick. It's very easy to build your account when the patterns work.
Okay. Yeah, because again, Kim, going back to like Ebola, those stocks, and I think coronavirus is a little bigger than that Ebola thing was. I mean, I always remember the Ebola stock run. There was one lady in the U.S. that had it. And she kept going out and riding her bike around, and everybody was freaking out, with one lady, But so this coronavirus is much more real. But those Ebola plays ended up being some of the greatest shorts ever, other than maybe the shipping stocks. Wow. But you just couldn't do it. You had to wait for the news to fade. You had to wait for the crowd to move on. So,
what other advice would you give to beginner traders now, guys, around this market and this situation?
I would say don't trade it. I mean, I would
today
say trade it
dreadful.
long. Trade it long.
I begged everyone not to trade today. Yeah.
I would almost say don't trade it because right now, like the coronavirus stocks, they've all already broken out. Like it's already all happened.
They're all doing
you
offerings.
You need to be there at the start.
Offerings,
Yes. So you can't go. They're all mid-range, right? So you can't go long because you missed it. You can't go short because a load of deaths might come out and they'll go even higher. So you can't go long, you can't go short. So just do nothing.
So totally agreed with Steve and Kim. Now, but it's a lot different. Now, if you're listening, we're recording on March 11th. 2 weeks ago, totally different scenario. But what has happened now is, we're into phase 2 of classic penny stocks. So phase 1 is the mania when they all go wild. Okay. Then phase 2 is the news starts to fade, the price starts to fade. They all start doing dilutions, offerings, okay? We talk about that a lot on the podcast, because they're smart. It's legal. They got to get that money. All these companies are failing. So once they start doing dilutions, they all start to fade. So you can't buy them now because we've seen intraday offerings. And if they do an intraday offering, stock might drop 30% on you. And then just like Steven said, vice versa, you short them. And then, listen, love them or hate them. What if like Donald Trump gets coronavirus or something? What's that going to do? And you're short a virus play and the president of the United States gets coronavirus. You're dead.
They said he was on a plane with guys who had been exposed to it.
I'm just using that as an example.
But I'm just saying.
Maybe it's Brad Pitt. It could be Brad Pitt too. So,
but that's why people sweep up though, like Tim Grattani.
Get it. Sorry. Go ahead, Steven. What'd you say?
I'm just saying Tim Grattani had his third $100,000 profit in the last 2 weeks. It's just because. Yeah, and it's just because he's seen the pattern so many times. He knows the perfect time to go long. He knows the perfect time to go short. But for everyone else, like if you're a newer trader, like fine, if you catch the breakout, fine, if a hot sector. But I wouldn't recommend anyone, unless you're an expert, trying to find the top on these plays, because it's too difficult unless you've seen something before. If you've been trading for 4 years and you've seen the ships, fine, give it a go. But or you've seen the weed plays, give it a go. But if you've not seen these patterns happen before, I wouldn't recommend it.
All right, but I love your point of sizing down too.
What do you guys suggest? And so let's say this airs in a week. Where are we going to be? Just based on your experience with Ebola and these other kind of like hot sectors, what is the next phase? And what is it that you would say by the time this airs, people want to maybe be prepared for?
You go first, Steven.
My answer's a bit complex. Basically, I'll be on the beach for a while, but when I start reading news to say that coronavirus is getting cured and all of the results are going down and things aren't going up, the next thing I'll look at is I'll search every single coronavirus play. I'll look for what's the most extended. I'll look for what's had the most consecutive green days. And then I'll look for a gap down in a first red day with significantly less volume than the previous day of that stock. And I'll short it because it means it's up too much. The catalyst is gone and all of the crowd have left. And that means it's going to go down, 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 down because it's way overvalued.
Well said, my friend. Yeah, I think I 100% agree with everything, which always pains me. I get like this like lower back. But what you're going to see, in my opinion, Kim, is you're going to see this crossing. But what's going to happen is the real stocks like Gild, G-I-L-D, had an announcement today that they're making progress. Bill Gates is plowing money into this. What's going to happen is you're going to start to see the real stocks trend up. And when that happens, the penny stocks are going to eat shit. And Steve, everything else Steven said is right. And that happens over and over and over again. It's like when Tesla ran, the electric cars ran, then Tesla holds up, the junk penny stocks die. It just repeats and it repeats. And especially like with that Gild news today, they're $1 billion biotech and they're making progress. Yeah. Who's going to believe in a penny stock that's up 9,000%, so.
Yeah, totally. Is there anything is this a time for somebody to figure out maybe what their specialty is or what their, should I be watching certain things now myself to say, okay, that looks like I would want to go like Steven's, like I'm understanding Steven's technique a little bit more now, or let's say your technique, Tim, would I want to take it on for like try it on?
I tell you, the best thing to do would be, this is the listener and to you, Kim, go back and replay what Steven just said. He laid it. He very well done. 2 thumbs up in that 30-second or 45-second soundbite. He laid it all out.
Yep. And I understood almost all of it, actually. So that's pretty exciting for me.
The reason I can say it so eloquently is not because I'm such a brilliant orator, but it's more because we look for the exact same pattern 1 million times a day, and we play the same pattern 1 million times a day. So when you think it and you look for it 1 million times a day, it gets very easy to say it because after 3 years, it's fun. Like I hate it because I try and teach me friends stocks, and I say to them, it's so simple. It's just this and this and this and this, and then every day comes back to us with like 9 questions of the 10 things I've told them. And the point is, but Tim will agree, penny stock trading is so simple once you've done it for a couple of years or 3 years or 4 years, if you've had a good education as well, which props to this man. He's responsible for a lot of it.
I mean,
if you've had a good education, it's very simple after a few years.
And that's the beauty of it. That's what I love about it. And it drives me nuts when people overcomplicate it. We've got an upcoming episode. We actually bumped it because of this coronavirus, but we're going to talk about SEC filings because that's our number one request. But it's like, man, this people that spend hours reading these filings and breaking them down. I'm like, it's penny stocks. They spike when the hype's there. When the hype fades, they do their offerings and they crash. It's the same thing.
It sounded like that SEC filing conversation. I think we had this on camera. That was a SEC. It was an announcement. It wasn't an SEC filing. It was an announcement, and you just felt it was almost less important what was inside the the context, the written, but that it was just superficial. That's what you were looking for. You were like, it was almost like, just look to see if it sounds like it's all trumped up and.
Well,
that was something else I went long. That was DGLY.
Yep,
that conversation was DGLY's, and that was because I went long a stock and lost $800. That was another mistake that I made.
Okay. Sorry to mix them up. I'm still learning.
Nope. Easy mistake to make. So, but no, Kim. Go ahead, Steve.
No, I was just going to say, Kim, your questions are very relevant, very pertinent, and it's very good to have you on because you ask a lot of the things. Because I used to do this basically when I was fresh green, and it was me and Tim. I used to ask all of the questions that people wanted to hear, but then as I've got more experience, I don't ask them anymore. So then
I got a Twitter DM that people are upset you're not drunk anymore, Stephen.
No, you did not.
Yeah,
did you really?
No, he said, I love the podcast, but he's like, they were more fun when Stephen was drunk all the time.
I know. I can't sustain that lifestyle, though. But I can try. I can try and be drunk for the next one.
No!
I mean, it's just to the listeners out there. I mean, I'm proud. I'm glad Stephen's been living cleaner. It's been like a month or so since I've gotten a 4 a.m. I love you tweet or text message from Stephen. It's like, I know he's living well when I don't get 4 a.m. I love you with all like smooches and hearts and stuff.
You're not listening to these people who are telling you to blow up your account. Why are you going to listen to this guy who's telling you should be drunk all the time?
Nah, I don't know if it's maturity and stuff, but Kim, honestly, I hope you don't go through the phases, because when Tim Bohen used to say you just short anything that's up, it wasn't an understatement. My strategy was to short it. No, but I believed it. I believe that if it's at more than 30%, it has to fail. And that's why you should not. We make fun of people. We'll laugh at traders. We'll call traders silly for just shorting anything that's up. But for those who are still doing that, I don't think you guys are idiots. Or if you're an idiot, if you are an idiot, then so am I. Because I literally thought that was a good strategy, and I tracked Excel data, I tracked 80 stocks, and I had a 90% win rate shorting stocks that were 30% up. They would all fail. But it just takes time to learn more and more and more and start finding out that you're wrong. But it's just good. It's be a scientist. Have a what is it? Not a fallacy. Have a thesis. Have a thesis. And then try and disprove it. It's the best advice ever. Have a thesis about the market, then try your best to disprove it. If you can't disprove it, you're going to make a lot of money.
It could be a terrible thesis. What do
you mean a terrible thesis? What is that?
Well, back to Stephen's point that he, again, he's kind of going back to when he was a newbie. And back when he was a newbie, he thought every stock up more than 30% would fail. It's a terrible thesis. But, it took him a while, but he figured out that it was a bad thesis. And he figured out that he needed these 5 or 6 criteria, then that stock that was up more than 30% would fail. But back then, he wasn't ticking through his process.
So can I just ask, I know we probably have to wrap up soon, but just so, Stephen, what do you explain that to? Because if you listen to Sykes, he's, even me, not fully even understanding, heard him say, you have to have as many variables as possible. So if you heard that, and yet you still thought this. What was that about?
Good question. I just had the ego, like many do, to think I know him better than him and I'm going to do better than him. And he's wrong and I'm right because I see something that he doesn't know and I'm special.
Okay.
And I'm admitting it, and it's egocentric.
Yep.
And I got very humbled by the market for not listening. But Tim Bohen will vouch from all of the emails he probably gets. I'm not the only one, eh?
Nope. That's again that way. Yeah, and there's a million different quotes about it. Be humble or the market will humble you. There's a million different quotes. But hey, I was there.
This illusion, guys. I have none of that illusion. Like, I am so completely sure that everybody knows better than me. Well, not everybody, but you.
Well, you're also not a dude.
True.
Ask my wife if I ever think I'm wrong.
It's so funny.
No.
Alex B, who we had on, we just, I think, put his episode up yesterday. We were talking about the differences between men and women. And I said to him, if a man sees a job description of 10 things and he has one of them, he'll throw his hat in the ring. If a woman sees a job description and she doesn't have all 10, she won't even apply.
No, but it's true. But overconfidence and underconfidence both have the strengths and weaknesses. Sometimes it's very good to be balls deep aggressive with testosterone.
And then we'll finish. I think that's a great point to finish on is, listen, if you, like, now you've got a process, it's totally cool to be cocky now. Yeah. But when you're 1 month in and you don't even know what you're doing, that's when you can't be cocky. But
that isn't cockiness. That's earned wisdom. You've earned the wisdom. You've earned the confidence. You're not cocky. You've proven it over and over again. Now it's not confidence. Now it's knowledge.
But there's a certain amount of balls to take a $100,000 position on a stock which you don't know the outcome of.
Well,
you can philosophize it in different ways.
Right now,
Tim Grattani does. Tim
Grattani. Yep. So he takes $1 million positions.
Wow. God,
but he's proven it. He's done it over 10 years.
Now maybe his wisdom and confidence and practice, has earned him that kind of chutzpah.
100%. So in summary, as always, these hot sectors that, roughly 2 to 3 times a year, we get something like this. Now, I want to be clear, this coronavirus run is unique. I mean, we saw 50-cent stocks go to $30. I think AHPI was the biggest one. It was like 50 cents to like $75. Okay. 50 cents to like $75 in, I believe, 1 day or a day and a half. So, the idea is early, look for that recipe, that high volume, that press release that has the buzzwordy title. We saw this with all the blockchain stocks, and now you can't just buy these and close your eyes. You still have to have a stop. You still have to have a plan. But if you're a long bias trader, look for these things that are in the public consciousness, because everyone's going to be looking to trade these stocks. And hey, whether you love or hate Robinhood, whether you love or hate commission free, whether you love or hate Reddit, okay, there's so many traders out there that when these things happen, I don't think it's unique that we saw the wildest run I can ever seen in my 15-year career, post commission free, post Robinhood, post all these crazy loons on Wall Street bets in Reddit. I don't think that's a coincidence. So then on the flip side, if you're short biased, just, I know it's so hard. I know it's so hard to wait, but if you are, this will fade. I mean, this will fade. Every one of these stocks will fail. If you can be patient, go to the beach, read a book. There's opportunity on both sides, and that's what's great about these setups.
Our book club's coming up, and we have the Fountainhead due, and that's a big 900-page book, people. So listen to the
reading, including me,
including you. That was me trying to save you, so that when we get to that episode, you're not like a 900-page book.
And
I've got it on Audible.
The audiobook, I know I've said it a million times on the podcast. The Audible audiobook of Fountainhead and Atlas Shrugged are awesome. The guy that reads them is incredible. So that being said, thank you everyone for listening. Definitely head over to SteadyTrade.com. You know, I always want to remind you, if you're on iTunes, we'll link to the book club. We'll link to all these things, all the references that we make. If you're watching on YouTube, hey, click the thumbs up, drop us a comment, hit us comments anywhere. We always try and cater these podcasts to what you want to hear. So if you're on the treadmill right now, drop us a comment, and we look forward to seeing you next time on the Steady Trade Podcast.